Right now, thousands of Americans who depend on their monthly checks are missing out on money they're entitled to, and they don't even know it. If you're receiving Social Security retirement benefits, supplemental security income, or disability payments, the next few minutes could make a real difference in your financial security. The Social Security Administration has rolled out significant updates that directly impact your payment amounts, eligibility requirements, and deposit schedules. We're talking about actual dollar increases tied to cost of living adjustments, changes in how the SSA calculates your benefits if you're still working, and critical updates to the asset limits for SSI recipients that haven't been adjusted in decades. These aren't small tweaks. They're substantial changes that could mean hundreds of extra dollars in your pocket each month. But here's what matters most: understanding exactly how these updates apply to your specific situation. Whether you retired early, you're collecting disability benefits, or you're helping a loved one navigate the SSI system, there are new rules you need to know about. Some changes are automatic, while others require action on your part. Let's break down exactly what's changing, who's affected, and most importantly, what you need to do right now to make sure you're getting every single dollar you've earned. Let me start by addressing something that's been causing a lot of confusion lately. The Social Security Administration doesn't always do the best job of communicating changes directly to beneficiaries, and that means a lot of people are left in the dark about updates that could seriously impact their monthly income. You might be wondering why your neighbor seems to be getting more than you, or why your check amount changed without any clear explanation. Well, there are specific reasons for these differences, and understanding them is absolutely crucial to making sure you're not leaving money on the table. The first thing you need to understand is that Social Security, SSI, and SSDI are three different programs, even though they all come from the Social Security Administration. Regular Social Security retirement benefits are based on your lifetime earnings and the age at which you decided to start collecting. If you worked for at least 10 years and paid into the system through payroll taxes, you've earned these benefits. The amount you receive is calculated based on your highest 35 years of earnings, adjusted for inflation. Now, if you didn't work for 35 years, the SSA fills in those missing years with zeros, which can significantly lower your monthly payment. This is something a lot of people don't realize until after they've already started collecting. Social Security Disability Insurance, or SSDI, works a bit differently. You still need to have worked and paid into the system, but the key difference is that you must have a qualifying disability that prevents you from working. The SSA has a very specific definition of disability, and it's much stricter than what most people think. You can't just have a bad back or arthritis. You need to prove that your condition prevents you from doing any substantial gainful activity. The amount you receive through SSDI is also based on your earnings history, similar to retirement benefits. But there are some important distinctions in how they calculate it, especially if you became disabled at a younger age before you had a chance to build up 35 years of work history. Then there's Supplemental Security Income, which is the program that trips people up the most. SSI is completely different because it's not based on your work history at all. Instead, it's a needs-based program for people who are elderly, blind, or disabled, and who have very limited income and resources. The income and asset limits for SSI have been absurdly low for decades, which has kept a lot of truly needy people from qualifying. But here's where things get interesting. There have been recent discussions, and some states have already implemented changes to these limits. For the longest time, individuals couldn't have more than $2,000 in countable assets, and couples were limited to $3,000. Think about that for a second. $2,000 in savings would disqualify you from getting help, even if you're disabled and can barely make ends meet. That's not even enough to cover most emergency expenses. Now, let's talk about the cost of living adjustment, which everyone calls COLA. Every year, the SSA is supposed to increase benefit amounts to keep pace with inflation, and they base this increase on something called the Consumer Price Index for urban wage earners and clerical workers. It's quite a mouthful, and honestly, a lot of economists argue that this index doesn't accurately reflect the expenses that seniors actually face. Healthcare costs, prescription drugs, and housing expenses tend to rise much faster than the general inflation rate. But the COLA doesn't fully account for this reality. The recent COLA increases have been higher than we've seen in years, which sounds great on paper. But many beneficiaries have noticed that their actual purchasing power hasn't improved much because their Medicare Part B premiums also went up, along with everything else they need to buy. Something that doesn't get talked about enough is how working while receiving benefits can affect your payment amount. If you're receiving regular retirement benefits and you haven't reached your full retirement age yet, there's an earnings limit you need to be aware of. If you earn more than this limit, the SSA will reduce your benefits by $1 for every $2 you earn above the threshold. A lot of people get shocked when they realize their check has been reduced or even temporarily stopped because they picked up some part-time work. The good news is that once you reach your full retirement age, this earnings limit goes away completely. You can earn as much as you want without any reduction to your Social Security benefits. But here's the thing that many people miss. Those benefits that were withheld aren't necessarily lost forever. When you reach full retirement age, the SSA recalculates your benefit amount to account for the months when your benefits were reduced or withheld, which can result in a higher monthly payment going forward. For those of you receiving SSDI, the rules about working are even more complicated. The SSA has what they call a trial work period, which allows you to test your ability to work without immediately losing your benefits. During this period, you can earn above the substantial gainful activity limit for up to 9 months within a rolling 60-month period. If you're able to work consistently above that limit, the SSA will eventually determine that you're no longer disabled according to their definition, and your benefits will stop. However, there are extended periods of eligibility and expedited reinstatement options if your condition worsens again, which provides some safety net. The problem is that these rules are incredibly confusing, and the SSA doesn't always explain them clearly, which means a lot of people are afraid to try working at all because they don't want to risk losing their only source of income. Let's address something that causes enormous frustration for millions of beneficiaries: the payment schedule. Your payment date depends on your birth date and the type of benefit you receive. If you started receiving benefits before May 1997, you generally get paid on the 3rd of each month. For everyone else receiving retirement or disability benefits, payments go out on the 2nd, 3rd, or 4th Wednesday of the month based on your birth date. If you were born between the 1st and 10th of the month, you get paid on the 2nd Wednesday. If you were born between the 11th and 20th, it's the 3rd Wednesday. And if you were born between the 21st and the end of the month, you get paid on the 4th Wednesday. SSI recipients, on the other hand, always receive their payments on the 1st of the month. If any of these dates fall on a weekend or federal holiday, the payment comes early on the last business day before that. One of the most important updates that people need to understand involves the taxation of Social Security benefits. This surprises a lot of folks because they assume that since they already paid taxes on the money they earned during their working years, their Social Security benefits should be tax-free. Unfortunately, that's not always the case. Depending on your combined income, which includes your adjusted gross income, any non-taxable interest, and half of your Social Security benefits, you might owe federal income tax on up to 85% of your benefits. For individuals with combined income above $34,000, or couples above $44,000, this maximum taxation applies. What makes this particularly frustrating is that these income thresholds were set back in the 1980s and have never been adjusted for inflation, which means more and more people are getting hit with these taxes every year.